They told you index funds were the safe bet, a guaranteed 10% return, the holy grail of passive income. But while you were watching the green bars go up, the math was changing behind the scenes. Today, the S&P 500 isn't what it used to be. It's no longer a diversified bet on the American economy. It's a concentrated gamble on 7 companies. And if you aren't careful, inflation, taxes, and hidden fees are quietly draining 50% of your wealth before you even touch it. This is the uncomfortable truth about index funds. Most investors think they own 500 equal pieces of the pie. They don't. In 2026, the top 10 names alone control over 37% of the entire index. Nvidia alone represents 7%. Apple and Microsoft, another 11%. When you buy an index fund today, you aren't buying the market. You're buying a tech-heavy portfolio. As billionaire investor Howard Marks warns, this concentration is worrisome. If these 7 stocks drop 20%, which they can do in a single week, the entire index crashes, even if the other 493 companies are doing fine. You aren't diversified, you're exposed. Then there's the real return trap. Wall Street loves to quote a 10% nominal return. But let's look at the December 2025 data. With CPI inflation at 2.7% and a standard 15% capital gains tax, your 10% gain isn't 10%. After Uncle Sam takes his cut and inflation erodes your purchasing power, your real gain is closer to 5.3%. In other words, your life didn't get 10% better. It barely moved the needle. This is how the middle class stays middle class, by chasing nominal numbers while losing the real war. But the biggest threat is the one you agreed to in the fine print. Fees. A 1% management fee sounds like a rounding error. But over 30 years, on a $100,000 portfolio, that 1% snatches over $270,000 out of your pocket. That is 15% of your total lifetime wealth. Gone. Michael Burry, the man who predicted the 2008 crash, calls this a passive investing bubble. The ease of index funds has blinded us to the cost of convenience. So, do you sell everything? No. But you stop being a blind investor. You look at equal-weighted funds. You consider downside protection. And most importantly, you stop listening to the marketing slogans. If you want to see the exact portfolio structure we use to fight concentration risk, subscribe and check the link in the description. Your retirement depends on the math you do today, not the hope you have for tomorrow.